There's no getting away from the fact that the US stock market is in its longest bull run since the Second World War.
It's the end of the Second World War.
With that said, bonds are not only an attractive way of hedging against an eventual stock market correction, but they provide a fixed stream of predictable income.
James Bond.
No, we're not talking about James Bond, we're talking about the fixed income investment. Whether you're interested in government, corporate, or municipal bonds, there's an instrument to suit all risk levels.
You play an instrument?
Yeah. In this video, we're going to explore how to invest in bonds, as well as the benefits and risks of entering the bond marketplace. If you're new to investing and looking to learn more, you're in the right place. Don't forget to hit that subscribe button, click that little bell so you get notifications every time we release a new video. Specifically in this video, we're going to be talking about how to invest in bonds.
James Bond.
I'm sure you've heard about them, so let's get right into what bonds are. Bonds are fairly simple to understand. Bonds are issued by governments and corporations as a means to raise financing. By investing, you become a bond holder, thus entitled to interest.
Bond trader,
Sorry.
This interest is usually fixed, so you'll always know how much money or interest you'll make. They're known as coupon payments. Your interest will be paid out usually every 6 or 12 months. Most bonds comes with a fixed duration. It can be anywhere from a couple months to decades. Either way, when the bonds do mature, only then will you receive your initial investment, and this is known as the principal. In some cases, such as with US Treasuries, a secondary bond market exists. This allows you to offload your bonds before they mature. The amount that the market is prepared to pay for your non-matured bonds is based on several factors, such as underlying risk of a default, demand and supply, and the strength of the US dollar. Here's a basic example of how bonds work. You buy 100 corporate bonds that are valued at $100 each. This makes your total investment $10,000, which is your principal. The bonds have a fixed interest rate of 4% and a duration of 10 years. The interest is paid annually. At the end of each year, you receive a coupon payment of $400. This amounts to the 4% of the principal investment. When the bonds mature in 10 years, you are repaid your initial investment of $10,000. This really illustrates that bonds are ideal for those seeking a predictable flow of income. Ultimately, unless you decide to sell your bonds on the secondary market or the issuer runs into financial problems, you will always know how much money you will make. If you think bonds are suitable for your long-term portfolio, you should know that there are several types that you should consider. Each bond instrument will come with various risks and yields. This will depend on the financial standing of the issuer, the bond duration, and the amount of capital being raised. Let's discuss the main ways you can invest in bonds. Government bonds come in many shapes and forms. The most used government bond is the Treasury bond. As the name suggests, Treasury bonds are issued by the US Treasury Department, otherwise referred to as T-bonds, the bonds that are essentially backed by the US government. In turn, this means that your money is as safe as it gets.
A government bond.
After all, should the government experience a shortfall in cash reserves to meet its coupon payments, it will simply print more money. Treasury bonds are often purchased by large-scale investors when the wider stock markets are very uncertain. Besides Treasury bonds, there are other types of government bonds, including savings bonds. These bonds sell at face value and have a fixed rate of interest. Bonds held for 20 years will reach their face value and effectively double. Then there's Treasury notes or T-notes. These bonds are intermediate term bonds maturing in 2, 3, 5, or 10 years. There's Treasury bills or T-bills. These are short-term bonds with a maturity of 1 year or less. And then there's Treasury inflation protected securities or TIPS. These bonds protect investors from the negative effects of inflation or rising prices. Similar to Treasury bonds, municipal bonds are issued by government authorities.
Municipal bond.
The key difference is that they are not backed by the federal government. Rather, they are issued by governments on state and local basis. Municipal bonds carry a lot more risk than Treasury bonds, as they don't have the backing of the Federal Reserve. This does, however, mean that you will get a much more attractive rate of return. Then there's corporate bonds, which are issued by large companies that are typically listed on the New York Stock Exchange or the NASDAQ. This is sometimes the preferred way of raising capital rather than giving away more equity.
Corporate greed?
The yield on corporate bonds can vary quite wildly. This is largely determined by the strength of the company's balance sheet, or in other words, as the likelihood of default increases, the yield will as well. Perhaps the best way to invest in bonds is through a fund. This works in the same way as a traditional index fund in the stock market, as you will be investing in a diversified portfolio of assets. Some bond funds contain thousands of instruments from various government and corporate marketplaces. This is a good way to access the bond market in a more passive and diversified manner. Junk bonds are not for the faint of heart, as they are issued by companies that are in a bad state of health.
Is a junk bond quickly depreciating?
You're more than likely to find junk bonds issued by emerging markets such as Venezuela. Junk bonds will suit those with a higher appetite for risk, as the yields offered are typically well above the market average. Junk bonds generally have a lower credit rating than investment grade bonds, and as such offer higher interest rates to attract investors, as the chances of default are much higher. Once you've assessed the type of bonds that interest you, you then need to think about how you can invest. If you're wondering how to invest in bonds in the most convenient way possible, opt for a traditional online broker. In some cases, your chosen bond broker will charge you a variable commission. For example, you might pay 0.1% of the bond value. This means that a $10,000 bond investment would attract a commission of just $10. Some brokers will charge you a flat fee when you invest in bonds. For example, you might pay $1 for each bond instrument that you buy. The main process of investing in bonds through a broker is as follows. You open an account with an online broker and upload some ID to verify your identity. You make a deposit via a bank transfer or a debit card. You select which bonds you want to invest in and the number of instruments that you wish to purchase. As and when the bond issuer distributes a coupon payment, this will be paid into your brokerage account. And when the bonds mature, the principal will be transferred to your broker and available to reinvest or withdraw. There are a lot of brokers offering free trades, so you can buy bond ETFs directly from the broker. Here are some recommended brokers that you can use. These brokers are considered safe as they are regulated. If you're wondering how to invest in bonds via an ETF or mutual fund, the process is generally the same as was just discussed. The main thing to remember is that the fund provider will charge an annual expense ratio, which is always expressed as a percentage. For example, you might be charged 0.2%, so a $10,000 investment would cost you $20 a year. If you're looking to invest in bonds through the US government, you can make the purchase directly from the Treasury Direct website. In doing so, you only need to meet a minimum investment of $100. Your coupon payments will be reflected in your Treasury Direct account, which is distributed every 6 months. You can also sell your US Treasury bonds before maturity directly on the Treasury Direct website. Now that we navigated how to buy bonds, let's take a look at the benefits of investing in bonds. Bonds are ideal for those seeking a fixed income. You will usually receive a coupon payment every 6 or 12 months until the bonds mature. Your future income is predictable as most bonds offer a fixed yield. Bonds come in various shapes and sizes, so you can choose an instrument that meets your financial goals and appetite for risk. Maturity dates run from a few months to several decades, so they are ideal for both short-term and long-term investors. And finally, bonds can be a great way to hedge against other asset classes such as stocks and currencies. Now let's break down the risks or drawbacks of investing in bonds. Unless you are investing in US Treasuries, bonds can be illiquid. This means that you might not be able to offload them until they are mature. Bonds are not risk-free. There is always a chance that the issuer will default on a coupon payment or worse, the principal. Bonds are particularly susceptible to changes in interest rates. Some bonds are difficult to get a hold of if you are a retail investor. You might also find that the minimum of sizes are high. In summary, many investors will allocate some of their portfolios to bonds. Not only does this provide a predictable flow of income, but it can be a great way to hedge against the stock markets. You should consider though that bonds are never really risk-free, especially outside of the US Treasury scene. Additionally, not all bonds can be sold on a secondary market before maturity, so consider the opportunity risks as well. Bonds aren't the most exciting investment, but it's good to learn about them nonetheless. If you found value in this video, definitely give it a thumbs up or a like. That really does help our channel out. We've been posting a lot of videos about investing, so you should make sure you check those videos out as well. And if you haven't already, leave a comment below. Let us know if you've had any success with bonds, and I'll see you in the next video.